So good morning, everybody. Welcome to our December quarterly webinar. It's at a really interesting point in the retail cycle. We're through Black Friday. We've got the final 2 weeks of Christmas trading to go. And what we're hoping to do is to give some insights, both in terms of what we've seen to date over that trading period, but also perhaps some of the insights of what we might see in 2023. Also, uncertainty is continuing to be the theme in our sector, unfortunately. So again, I'm joined by a number of colleagues that will hopefully help give some insights that are useful as you go through into the new year. So with that, I'm going to pass to Sophie to take us through the first part of our session. Sophie, over to you.
Thanks, Laura, and good morning, everybody. So next week, we see the launch of our retail forecast report, which covers the key trends expected in 2023 and sets out opportunities and challenges to retailers in the year ahead. I just want to spend the next 10 minutes or so covering some of the trends that we've seen through the like-for-likes delivered through our high street sales tracker. Just as a reminder for those on the call, our high street sales tracker looks at like-for-like spend across discretionary categories. And as we know, these are the categories that have been impacted most by the tightening consumer purse. It looks across fashion, lifestyle, and homeware. Just a bit of context in respect of the past year and what's borne out by these figures. As you can see, as we came out of the lockdown of 2021, everyone was feeling a bit more optimistic and looking forward to a year of no restrictions. However, the combination of the Ukraine conflict, supply chain shortages, and rising inflation soon wiped out that optimism and began to severely dent consumer confidence. Not only did the conflict impact energy, but also, given Ukraine and Russia provide 1/3 of the world's wheat, it immediately had a significant impact on the cost of living crisis. At the same time, China's zero COVID policies, which pleasing to see that since last week, they're beginning to be relaxed, but again, causing severe supply chain issues. Added to this, we can't forget Brexit, with major slowdowns in transporting products between the UK and the EU, with a system that is far more bureaucratic since the UK left the customs union. Last week alone, it was reported that the average household is spending £200 more simply as a result of Brexit. And whilst these things individually may appear small, cumulatively, these have a big impact on the cost of living and a disproportionate impact on retail. As well as border delays, another impact has been staff shortages. And yes, it's impacted hospitality and areas such as haulage, warehousing and logistics. But again, retailers are having to raise wages to compete for resource. So although you can see that the total like-for-like started the year strongly, they started to trend downwards from April. There was a short-lived spike in July, but again, it was trending downwards all the way through to October. The figures, the red line on the bottom, the figures for online spend, however, have been far weaker than we've seen either pre-pandemic or, of course, during the pandemic, when it was very often the only channel open. And I'll come back to the November and the Black Friday sales. But overall, it's expected that for 2022, consumer spending will drop by 1.2%. With inflation running at over 11% in October, this means that 1.2% drop actually takes out in excess of 10% of volume. Taking out 10% of volume in the retail sector has a significant impact. So whilst we're expecting an increase in overall consumer spending in 2023, again, it will be driven by inflation, and we're expecting those volumes to fall even further. all retail segments have been impacted since spring, but actually homeware and lifestyle have been more impacted than fashion. But perhaps this is because there were weaker comparatives during the COVID years. Next slide, please. The marginal growth in total like-for-likes in the first 2 months of the golden quarter, that's October and November, reflects consumer caution caused again by the cost of living crisis. And again, fashion has outperformed the other sectors, but perhaps that's people shopping more on fashion, given it's the first time that we're seeing Christmas parties again. What's interesting about the spend in October and November is that the weeks leading up to Black Friday saw a fluctuation of like-for-likes across channels and segments. As I say, fashion outperforming the other two. But we also saw those 2 weeks before the Black Friday week higher than the Black Friday week itself. And this is indicative that many retailers have been bringing their promotions earlier this year and consumers have been spending earlier. For Black Friday, the results were not positive across lifestyle and homeware. Again, the fall in these segments show that the caution in the consumer and spending being taken away from the bigger ticket items. There's many reports that retailers benefited from the popularity of Black Friday discounts. However, these stats show that overall growth was below inflation. So again, volumes during the Black Friday month have fallen. Our report on the month of November is out tomorrow, and that shows an overall like-for-like for November below 5%. The really big question is, has Christmas shopping now happened? Will the consumer continue to spend in what is the most critical month for UK retail, being December? Will we even have a Super Saturday this year? It looks as though the heavy discounting may have cannibalized December sales. The reality will probably be that consumers will now hold off spending on discretionary spend categories, and essential spend with high food inflation will take the majority of the consumer purse. There are also concerning reports that following Black Friday, there have been record levels of returns. And we all know that returns cost retail is an expensive item for retail. The implication of all this early discounting is that retailers have got high stockpiles. And we not only saw substantial discounts on Cyber Monday, far higher than we've seen in previous years, but reports from large retailers who are cancelling orders and returning inventory from their brand partners. Management teams will be really focused on turning inventory into cash. For many retailers, they're caught out with too much stock. Demand has taken a significant hit and inflation has risen much more quickly than expected. Black Friday was perhaps the chance to turn that stock into cash, but as I said, has it eaten into December sales? So for all of these factors, it's created the perfect storm for retail, with reduced consumer spending, significant increases in costs, and putting enormous pressure on already squeezed margins. Despite the costs that all retailers have undergone in recent years, they will need to seek further trimming of costs where possible. The challenge is that to trim costs now in staffing and processes requires investment in areas such as automation and changing supply chains, which are not quick solutions. They'll have to take extra care with their stock buying. Predicting consumer preferences has never been more important in committing cash to inventory, holding more and more critical than ever that retailers understand their target customer and offer the product range and service that will lead to sales. So driving AI for these predictions, but also data to reduce costly returns. Perhaps this is why we saw last week M&S buy Thread to enable more curated and tailored purchase by their customer and reduce returns. But none of these are quick solutions and requires investment. Spending in non-food is expected to fall in 2022 by 2.9%. So that's a larger fall than the overall fall of 1.2%, and it's again expected to fall in 2023. Food and grocery is the only area where consumers are expected to increase their spending, and that's driven by inflation, leaving less for discretionary spend categories. Next slide, please. Our report, as I said, launches next week, and this is a summary of the key themes that we will be covering when we deliver our retail updates in January. I'm not planning to go through these, and one of our speakers later will be speaking about some of these trends separate from our report, so I'm interested in their insights and thoughts. But I'll encourage you to pick up our report on Monday and join us for our updates in January. I just want to pick up one of them, and that's the trend of retailers in these climates to trade down. We've seen this before. Back in 2008, people trade down and seek value. And the biggest challenge for retailers are those that sit in the middle. So those retailers in discretionary spend categories not providing value or a strong brand proposition to differentiate themselves will find the challenge even greater. For many low-income households, discretionary income may have fallen to zero, and therefore spending on these items requires a greater consideration. The pressure on mid-market retailers finding an attractive differentiation will only intensify. Up until now, the more affluent households were somewhat insulated through their savings in periods from working from home and not having the holidays. But with mortgages up and the cost of living crisis, this category has been impacted, and it's impacting far wider across all consumer groups. So retaining customers and attracting spend, unless it's value driven, will be very difficult. So that all sounds quite doom and gloom, but what I do want to say as a closing remark is that we see over and over again, both the high street and retail prove themselves again and again that they can reinvent themselves. We have seen before that in these trading conditions, the strong get stronger and the weak get weaker. Those businesses that are able to adapt and flex will outperform for the longer term and set the platform for the next wave of changes to face the retail landscape. I'm going to pass back to Laura now, who's going to introduce our next speaker.
Thanks, Sophie. Really insightful. And equally in the audience, if there is any Q&A that you would like to pose to any of our speakers today, please do drop it into the Q&A box and we'll pick those up at the end. So we're now joined by James, one of my fellow partners who works in our business restructuring team. Clearly, we have seen some very interesting and unfortunate demises of some of our UK British brands over the golden quarter. And so what I'd like to introduce is James to take us through some of those things, both watch outs, but also opportunities as we go into the next year. James, over to you.
Thank you, Laura. Good morning, everyone, and welcome again to our webinar. Just continuing the theme from Laura and Sophie, at the risk of stating the obvious, we are clearly in some very difficult times that show no signs that they're going to end very soon. However, looking at the positives, as history dictates, from those difficult times, opportunities will arise, and that will arise in retail. And I have no doubt that some of those undoubtedly will come from formal restructuring processes. Having advised on the buy side and sell side of businesses being bought from formal restructuring process, I wanted to give you, by no means exhaustive in the 10 minutes that I've got, some of the key actions that I think you should look out for if you are a potential acquirer or indeed a funder looking to assist an acquirer buying a business out of one of those processes. Much to my frustration, over the years, I've had many people say to me, I would have been interested in buying that, but I didn't really know what to do. So hopefully this will maybe help you a little bit if that is something you're thinking about. Just in terms of kind of painting the picture of where the landscape sits, particularly in respect of retail in the kind of formal restructuring process, Previously, we saw a lot of company voluntary arrangements. Indeed, some companies did 2 or 3 company voluntary arrangements, and that has now kind of dissipated. That used to be where the incumbents were seeing an opportunity to retain control of the business, but also in particular cram down their property costs, i.e. squeezing the landlords into various categories. That's now changed for 2 factors, I think. One is potentially incumbents are not seeing that there is a future from doing a CVA. They might need to do something more dramatic. And also with the recent legal cases, New Look, for example, the strength of the landlords in the CVA arena has strengthened somewhat, so it is much less attractive. Restructuring plans, like in most sectors, have not yet really taken off in terms of the retail sector. Whether that changes, I don't know. I'm not going to dwell on that today. If I start talking about restructuring plans, that would probably take up most of the session. So we have kind of swung back to administration being the primary tool, and we've all seen that recently with Made.com and Jules. The advantage of administration, it is a relatively quick process and is reasonably well understood in the market. Next, clearly, are the ones that have done really well in this space recently. They seem to have kind of taken over from the likes of Edinburgh Wool and Mill, who in the past were also very good at getting themselves into these transactions. Out of the 2 duels for me, in terms of a transaction, given the work I do, is a far more interesting transaction than Made, in the sense that as I was following it through the press, as I'm sure we all were, it didn't look at one point so Next was going to get it. And then when the deal was announced, I did look, admittedly with some significant pangs of jealousy, that it was a deal that the administrator will be pretty thrilled with. Next took the head office, they took the stock, they took the vast majority of stores. I think they only closed 19 and retained about 150. And they've taken on 1,450 employees there or thereabouts. That's very attractive to an administrator in the sense that it takes away what could be a long tail of closing shops and unfortunately making employees redundant. That is a very, very nice and attractive transaction. So if you're in a situation where you see something that you think maybe going into some kind of formal restructuring process and you want to be in a position to look at a possible acquisition, what are the kind of key actions that you should be looking at? The retail space over the years, I have to say, with ins and outs, has been kind of dominated by the same runners and riders. So you do have to, for want of a better description, gate crash the party. You need to be in there. The first and most important thing I would say to anyone is be funded. There is no point approaching somebody that's trying to sell in a formal process with a proposal or a bid that you can't prove funding. If you can't prove funding, you're not going to get beyond base one. You will just simply be discounted. And my colleagues in corporate finance and BDO will be more than happy, I'm sure, to look at funding options if you're looking at that possible acquisition. Understand the process. As I said before, I've had too many people say to me, I would have been interested in buying something, but I didn't really know what the process was. So do take advice. It will save you money in the long run. I have no doubt of that. In terms of the process, normally, it's not exclusive, but if a business is going to go through a restructuring via administration, it would normally follow what we call a pre-pack administration, which I'm sure everybody's familiar with. But in essence, the negotiation for that will be done in the weeks leading up to administration. So you will have a period where you'll have access to a data room, you will formulate in your mind what you want to bid for, and then the best and final bids will be put in. The administrator will appoint a preferred bidder, and then at 11 o'clock on a certain day, the administrator will be appointed, and a few minutes later, the sale will be completed with the preferred bidder, and the preferred bidder will have acquired the business and assets and will move on. So it's a fast-moving process, a very fast-moving process. So get in quick. Don't sit and think about, is this something we want to do? Try to construct your deal before you move forward. Note your intention immediately. Just note your intention with the administrator on day one. There's nothing problematic with that. There's not going to cost you any money. and if in the future you wish to withdraw, then again, that's something that happens all the time. So make sure that you are in the game at the very outset. Take professional advice. It does save you money, particularly if you're unsure of the process. And speaking as someone who sells businesses as an administrator, I'm delighted when a acquirer comes to me with people that are professional advisors, but also have a clear knowledge of how an administration process works. But that can cut out so much toing and froing, particularly on the legal side. It's a huge advantage, both to the buyer and the seller. The other thing I would say is know the risks. If you're buying a bricks and mortar retail business, the employees are going to be a big number. Once you complete the transaction, you're taking those employees and their contracts over under 2p. So make sure that you know your liability there, because once the deal is done, the contract is transferred and you are on the hook for the 2p liability going forward. So if you make people redundant in the future, then it's at your cost. Also, just be very aware for two reasons about the position on the head office staff. One, they can and frequently do have far better contracts of employment than the shop staff. So just make sure that you fully understand, if you are taking on the head office staff, the level of liabilities that you might be getting into. And they could have long notice periods, 12, 15, 18 months, for example. But crucially, as we saw on Next, buying duals, if management are key to the business going forward, i.e. there's some unique qualities in management that really drive the business and you need them, make sure that you are on board with them. Next took Mr. Jules with them in the acquisition. So clearly they saw real advantage. If management are crucial and you don't get them on side and they're not there after the acquisition, then you could end up with a transaction that goes very, very wrong for you. Make a nice clean offer. Don't overcomplicate your offer with complex stock realization scenarios, etc., deferred consideration, and then as you go through it, chop and change it. Administrators get frustrated when they think they have a deal that ultimately gets changed, and that just then opens the door for other people to come in and get the transaction before you. Be very aware that you're going to get limited diligence. You'll get access to the data room if it's done via pre-pack, or a data room for that matter if it's done post-administration, but you're not going to get the opportunity to send in squads of people to do vast due diligence. It's going to be a fast-moving, quick process. So you have to accept that there is going to be a calculated element of risk that you're going to have to take. And once you are the preferred bidder and you get the transaction papers, the sale and purchase agreement, just be very aware that you're going to get no warranties whatsoever. It's pretty much a sold as seen. A business and asset transaction through an administration will be conducted in that way. The final point I would make is tax. I wouldn't say that you're going to get, it's highly unlikely you're going to get any major tax advantages from buying a business out of administration. But the big thing I would say is just be very clear as what you want to do in the future, because what you do now will dictate what happens in the future. So if you have some very clear ideas about structures and how your tax planning is going to be done, then make sure you build that in as you complete the acquisition. BDO as a firm, we're pretty active in this team at trying to identify opportunities, speaking to people that might be interested in opportunities. So if you feel that's something you wanted to talk about or get more detail on, as I say, in my 10 minutes, I can't give you a completely exhaustive guide as to how to transact in these scenarios, but we are more than happy to discuss and have conversations around possible opportunities and acquisitions. I think that is my time up, Laura. So I'm now going to pass to our double act for the day, Tom and Damian. Thank you very much, everyone.
Thank you, James.
Thanks, James.
For the next 10 minutes, just wanted to come back to a slide that Sophie had, which is an insight into the trends that we're seeing in 2023. And we're going to have a 10-minute chat, Damian and I, on a couple of those aspects. But first, let me just introduce Damian, a friend of the firm, Damian's the founder of Radius Brands Group. They help brands and retailers expand via product extensions in new international markets. And great experience that Damian has to bring to this conversation. He's also chair of the Retail Trust Ambassadors, who do a significant amount in the sector, and also president of the Retail Fellowship Club, a long-established business called, foundation called the 20 Club. Thank you very much, Damian, for joining us. To kind of kick off, one of the themes that we put up on the slide was around sustainability and ESG in retail. And without kind of, again, picking up on some of the doom and gloom, there have been businesses who've made great progress here. But one of the thoughts that we had was, in that pursuit of being better for planet, people, and profits, do you think there might be a bit of a reality check with some of these conditions that might halt the progress retailers have made?
Thanks, Tom. I think the other thing, just to add for the people on the call, for 16 years, I owned a large manufacturing supply business, supplying the high street from everybody from the grocers to Arcadia, etc. We own factories in places like Sri Lanka, Bangladesh, India, which we own directly, as well as working with third-party suppliers. So, and my context around this question around sustainability is that I was a very early adopter in terms of that back in 2007 and 8, when I introduced the first fair trade supply chain on cotton and recycled polyester. So in answer to your question, you know, obviously we're facing into some pretty challenging economic times in our sector. Sustainability has gone a long way over the last few years, you know, and it needs to. The retail industry, including the supply chains, is the second largest polluting industry after oil and gas. It's one of the largest contributors to European greenhouse gas emissions, accounting for over 30% of all emissions in Europe. So this does give our sector a huge opportunity and a huge responsibility to play its part in combating that climate change. And as I've said, you know, there's been enormous progress made. But sadly, I think what we're also going to see is inevitably there's going to be some slowdown of that progress that we've made with some businesses. And it's going to push sustainability probably further down the agenda. You know, we've heard already from our other speakers that, you know, many businesses are fighting for survival. The economic outlook is not great. And often it's easier and cheaper to do bad than good. You know, virgin plastics are cheaper than recycled. Sustainable yarns and fabrics are more expensive than non-sustainably produced products. So, you know, we have some tough choices. However, you know, on a positive note, you know, there are three important things to remember when it comes to sustainability and what we do within it. You know, we've got a lot of retailers on this call, and I know a number of them have made some great progress on that. I think just three things to take away on sustainability is that, you know, it is a real opportunity for businesses to reduce costs. We've seen some that have really begun to generate their own renewable electricity, people like IKEA, Lego and others. So they've already, to some extent, de-risked their increase in the energy costs. Others have significantly reduced packaging and improved efficiencies. Secondly, for those on the call that might not be up to speed with the new legislation, there's a lot coming down the pipeline. The EU's committed to being climate neutral by 2050, and they want to be the first continent to achieve this. There's numerous new legislation and guidelines coming out. There's EPR, which is the extended producer responsibility legislation, which is going to be in full force from April 23, I think it is, and a new digital product passport, which is likely to come out in 24, which is where retailers and brands will have to showcase the environmental impact of every product that they produce. Finally, the third thing, and I think it was on one of the slides I saw earlier, you know, consumers now more than ever are demanding to buy into sustainable brands and businesses. You know, consumers want to see that businesses are putting people and planet before profit. And a recent survey that Retail Week did earlier this year showed that the majority of consumers surveyed were more likely to buy from a retailer or brand with strong ethical credentials. I think that the survey was like 55% or something like that. You know, so companies that are looking to do things more sustainably will be the ones that benefit in the long term. You know, it's not an option really to ignore it, but I'm sure it will see a bit of a slowdown. That was probably a long answer, but hopefully there's a lot of...
No, that covered some really interesting points, Damian. I'll pick up on one just because I think it is worth combining with another trend we're seeing, which is this younger consumer demographic who are engaging with brands in a different way. Obviously, the purpose of that business is, something that is a unique differentiator now, and often that is entrenched in something that's a bit more sustainable or a bit more different to the norm. Who are you seeing that is doing a really good job in, I guess, engaging with that new consumer, either via some new social media channels or the access to the consumer, or in the proposition that they are developing and bringing to market?
Yeah, good question. We've seen a number of fantastic brands launch over the last 5 years that really lean into the whole ESG piece. And they've done a really good job. I mean, I'm going to just pull out two that spring to my mind. One is a British brand called Passenger. They're doing a great job on their sustainability credentials. 80% of their range is made from responsible materials like recycled cotton, recycled polyester, hemp, organic cotton. And in addition to that, they plant a tree for every order they receive. And I did check on their website yesterday, they've planted 400,000 trees. So the owner of this business must have one hell of a wood. That's all I'm going to say, which is fantastic obviously for the climate. The second small brand that I know they founders of well is a small, which many of you might not have come across yet, is a small footwear business called Loci, L-O-C-I, set up by a couple of English guys. It's ocean plastic. They're made from ocean plastic. And, they've really leaned into sort of new media channels. So celebrity endorsed, great TikTok. They've got loads of stuff going on with Hollywood actors, et cetera, et cetera. They're getting a real groundswell of interest, and they've only been going 18 months, and it's phenomenal. However, I think, the important thing to remember here is these small brands, whilst they're doing great things, they're not moving the dial massively. And we do need to lean into the big retailers who, I'm pleased to say, are also taking, huge steps in the direction of sustainable sourcing and looking at how they run their business. And just to pull out a couple of good examples, I think Tesco and Co-op have done a great job. They've focused heavily on flexible food plastic waste. Now, arguably, you might say that that's probably due to the new packaging tax that I mentioned earlier and the sheer volume of tax they'd have to pay. But regardless of that, they're doing it, and it's making a massive difference. They're building an infrastructure to manage that. I also mentioned about IKEA. They're obviously producing a lot of their own energy, and they've also now introduced a take-back scheme in their stores, which is fantastic. Asda have also been partnering with charities to build concessions to sell secondhand clothes, and have launched a sustainably living store to refill your groceries. They're also working with a charity called New Life, and they're sending all their unsold stock or recently out of date stock through to New Life's charity store, which again saves landfill and reduces their carbon footprint. And finally, I think I can't finish without mentioning Selfridges, one of my favorite stores. They've got initiative across all elements. They've committed to nearly half of its customers' interactions to be based on resale, repair, rental, and refills by 2030, which is only 8 years away. So, you've got a great company called Her, which is H-U-R-R, owned by Victoria, who's done a fantastic job. You might have seen last weekend, Kate Middleton was wearing one of her dresses, and they've just launched with Matches Fashions as well as a rental platform on there, as well as being in Selfridges. So a good collection there of small brands and big brands making a big difference.
And linking, I guess, some of the sustainability pushes retailers are making in with what James mentioned, which is, in retail, as we know, we have significant areas of cost or opportunity, should we say. Obviously, if you're bricks and mortar, there's a rent and a rates point. The other one is usually biggest on the P&L is staff. And actually, a lot of businesses now are really trying to turn to staff as the differentiator in terms of, motivating them. But equally, in this, this current climate, there's a lot that people are doing to invest in their well-being, to support them, to give them training. And I know that, one of the roles you're involved with, the Retail Trust, does a huge amount in the sector. Just wondered what your thoughts are on what retailers can really be doing now to kind of help and support staff to keep them well and motivated.
Yeah. Just before I talk about staff, one thing I forgot to mention was just jumping back to sustainability, there's an organisation called Products of Change, POC, which is a British organisation which I'm the retail ambassador for, and they're helping thousands of retailers face into sustainability around all this new legislation, packaging, etc. So I just want to flag that up for anybody on the call. Products of Change, if you go to their website, great organisation, and certainly worth joining and recognised by UN. So, sorry, Tom, on to Retail Trust. All my voluntary roles coming out today. Retail Trust, a fantastic organisation. I know I've had a quick look at some of the people that are on this call, and I know a number of them are actively involved in the Retail Trust. It was a charity that was set up in 1832, and I'm going to use them as an example when we talk about staff and the importance of staff in retail. So for 190 years, the Retail Trust has been caring for and protecting the lives of people working in retail. We're retail leaders on this call, and it's important for us to all believe that the health of our colleagues is the foundation that they need to flourish both in their sort of work and their home lives, which in turn creates a more sustainable and successful future for the retail industry. The slight disappointment, I suppose, is that retail is not a great place to work at the moment, and it's been really difficult, and there's some really scary stats that have come out this year that many people might have heard from the British Retail Consortium or from Retail Trust. And I think before I answer your question, I just want to, for those that might not have heard them, 1,500 workers were surveyed by the Retail Trust earlier this year, and 8 out of 10 of those surveys said that they'd had mental health and had deteriorated in the past year. 21% of British retail workers were considering leaving the sector because of the challenges they were facing. And interestingly, when you look at the larger retailers, that number increased to 31% for those working in larger UK retailers. And 90% of store workers had faced abuse from customers, 1 in 3 of those. So that was on a weekly basis. So the Retail Trust, which is there to support retail colleagues, they've helped, again, a few stats, they've helped over 270,000 retail colleagues over the last year who've called into to our 24-hour helpline. And the Retail Trust delivers counselling sessions, critical incident support, financial aid, supported living, and digital self-help services. I think the health of our industry is absolutely key now, and it has never been more key. A number of retailers have been super engaged with the trust, and I'm going to shout out people like Pets at Home, TJX, Kingfisher, River Island are all really good examples of these companies that have been doing loads of training, asking for benchmarking data from the Retail Trust to help them improve and also ensure their services are embedded in the business, and that's been engaged throughout the business. I was a director of Matalan for 5 or 6 years, and I saw firsthand how fantastic the Retail Trust services were for our business, for sure. And recently, weaving in the 20 Club, we had a senior CEO of a major UK department store who was horrified when he found out that over 250 of his staff had been in touch with the Retail Trust for things like hardship grants and other support, and he was straight into rectifying that situation. Furthermore, just jumping back to someone like TK Maxx, I introduced the trust to Louise Greenless, the president of TK Maxx. They thought it was a fantastic solution for their tens of thousands of colleagues that they have. They've really embraced all aspects of the services provided, and that helps the staff as well, knowing that they've got support across education, legal, financial, etc. And we all know that the cost of high staff turnover is something that retailers will want to avoid, more than ever now. And it's critical that employers take action now to protect the people and their businesses. And what else can we do? Sometimes it is the simple things, Tom. It's telling people they're doing a good job, make people feel valued. We've had 3 really disruptive years. I think people have lost confidence, and I think that's at all levels. I'm sure there's a lot of people on this call, that over the last 3 years, it's changed our outlook considerably. We all feel perhaps more vulnerable than we might have been. We've maybe lost our sense of self. We as business leaders, really have the responsibility to ensure our staff feel supported, valued, recognised, empowered, to give them the bravery and confidence they need to be the best versions of themselves. We also need them to know that they can fail, and that the culture of our businesses will support failure as well as success. We all fail all the time. I certainly do. And we learn by our mistakes. So, I think training is important. I think the final thing on that, I think training, I saw firsthand, when I was at Maslan, I was taking people on in my team that I never met. They came into the office to grab a computer, and these were young people. It was their first job. There's been a real lack of investment in, some of those sort of junior line managers who just have not really experienced what it's like to work in this great industry, which is retail. And again, that's where the Retail Trust, I think, can help. They've now got 8 CPD accredited courses, which people can get involved with. So
thank you for that, Damian. There are a couple of other questions that I think we want to cover. We're going to probably come back to a plenary Q&A and ask the audience also to offer up questions, because those insights of the access you've got to some of those retailers and CEOs is really, really insightful. I'm going to take a chance now to pass to my colleague Neil. Again, picking up on themes of what we are seeing, we're going to turn to his area of expertise and look at some of the tax opportunities and challenges coming up in the new year.
Thanks, Tom. Thanks, Damian. Very insightful. Ben, if you can go to the next slide. So I'm conscious of time, and I want to allow us some time for Q&A. So I'm not going to talk about this slide in any detail. It will be in the pack that comes out after the call. We've heard a lot about the headwinds and the challenges the retail sector is facing. And tax, I think, is one lever that is often forgotten but can play an important role, particularly if you play your cards right, to improve the cash position of a company, which in the current climate is really important. And I think the ideas that I'll talk about in a minute broadly fall into 3 categories. It's number one, making sure that you're taking advantage of and maximising all available tax reliefs. Number 2, it's about getting the basics right and having some good housekeeping procedures around what you do on the tax side. And then thirdly, I think it's about identifying the things that you've absolutely got to get right, the non-negotiables, because if they go wrong, then basically you'll end up with a very unwelcome, unexpected tax bill, and probably a long protracted negotiation with the tax authority, either here or in the UK, outside the UK, sorry. So what are some of the things that you can do? On the corporate tax side, I think the first 3 bullet points come under the good housekeeping bucket. So, a lot of companies these days pay their tax in instalments. If you forecast profits at the beginning of the year, which is significantly less when the outturn comes out, think about your calculations. Can you revise those downwards so you're paying less? Can you, if you've overpaid, can you actually approach the revenue to get a refund? Okay. In the maximised reliefs bucket, I think the 2 I'll pick out are R&D claims and capital allowances. Clearly, spend is challenging at the moment, but if you are spending on innovation, product development, etc., don't forget about the very valuable tax relief that you can get in R&D. And depending on your profile, that could give you a tax repayment. Similarly, capital allowances in the COVID period, we've obviously got enhanced relief to encourage spend. So are you maximising the spend on fixed assets in the right buckets, and making sure that you're getting as much relief as you can. The one thing to forget, not to forget, is these claims that you can put through have a window of opportunity. So it's not just what you're doing in the current year. You may want to revisit prior claims as well to see if you can improve on a position and generate some repayments. On the loss front, we've got to have a think about where is most beneficial to claim loss relief, and hopefully generate some refunds there. Clearly, the tax rate is going to go up to 25% next year, so you're going to get a better return if you can carry your losses forward and use them in a later period. But equally, if you need the cash now, that may be the quid pro quo that you take to generate that cash return more immediately at the low rate of 19%. On employment tax, again, a lot of housekeeping stuff here. The one I want to draw out here is the IR35. This is definitely something to make sure you get right. The IR35, if you've been following it in the press, is all to do with payments outside the payroll to contractors. Are they employees or contractors? It's been an on-off saga for a number of years. It's definitely on now following the autumn statement, and it's something you need to look at carefully to make sure that you've got your procedures in place to deal with that appropriately. We know, because the revenue are looking at this very closely, that the retail and consumer market sector is going to be definitely in their eyesight for an area of focus. And we know, from past experience, whether it's under living wage, payments to contractors, or just employees and benefits generally, the retail sector gets more than its fair share of challenges from the revenue. So take a close look at that and make sure you get it right. Picking up what Damian and Tom were talking about training and sort of staff well-being. On the training side, then, if your training programs that you offer employees can be conducted under the apprenticeship levy, then clearly there's access to cash through that fund that you're paying into. So, it takes a bit of time to go through the procedures to make sure you access it, but it can be a very valuable relief in the current climate. And then thinking about what James was saying about if you're taking on part of the business through acquisition, got to retain and incentivize key management. Think about how you structure their pay. Can you use tax efficient equity incentives, share option schemes? Can you do something creative around deferred bonuses based on certain criteria? All of which, you haven't got to pay for now, but hopefully when we come out of the current difficult climate, everybody can share in the upside. On the indirect taxes, again, a lot of good housekeeping, particularly on the back side of things. So lots of things to think about there. The one I want to call out here is duty. Quite often when I talk to retailers, they're heavily reliant on logistics firms or brokers to carry out their duty arrangements for them. Totally understandable. It's a very complex field, and in the post-Brexit world, it's an absolute minefield to navigate through, and you've got to have the right skills to do it. That said, I would encourage all retailers to really have a handle on what they're paying duty and really challenge some of these points that I've raised up here to make sure that you're paying the right amount. So have you taken into account things like discounts in your duty calculation? that could provide a significant saving. Are you using the right valuation? Can you strip anything out from your landed costs that duty is applied to? Are you accessing free trade agreements where appropriate that give you a beneficial duty rate? And then perhaps a medium-term strategy, if you haven't already done so, have you looked at customs warehousing and other reliefs where you bring stuff in, re-export it out, and maybe reshape the packaging, put it into different tranches, all of which can attract some benefits. Across all of these, you'll see time to pay, and this is where you approach the revenue and say, I'm struggling to pay my tax liabilities. Can I agree some sort of instalment payment to pay that liability over a period of time? That is still open to all businesses on corporate tax, employment tax, and indirect tax. But unlike the COVID period, where you could just agree those arrangements with a relatively straightforward meeting or phone call, the revenue will be looking and scrutinising your ability to pay, and you will need to show forecasts and the ability to pay over that period of time that you agree. But it's one to have at the back of your mind. Clearly, it's not totally in your control, and you will need to negotiate with revenue to get that. I could probably spend another 20 minutes talking about all of these in more detail, but I'll leave it there. You will get a copy of the slide, and if you've got any questions, please post them in the chat or contact me afterwards. Laura, back to you.
Thank you, Neil. So I'm going to ask everybody to turn their video on and join me again for a short Q&A as we finish the session. I'm not sure whether people can actually see me. I can't see myself, so no, I
see you, Laura.
Can't see you.
You can see my screen, but I've disappeared. So we'll see if I arrive like a magician. So one of the questions that was posed on the back of a couple of the discussions this morning has been around supply chain. Clearly, the last 2 years, supply chain issues have been a phenomenal challenge for our sector. The last year we've experienced have seen an incredible peak on shipping costs and container costs coming into the market. And thankfully, we have seen those drop quite considerably as we go into 2023. But Damian, your thoughts on supply chain? Do you still think people have to try to mitigate those supply chain issues? Or do you think we're fingers crossed, one positive for 2023 is that some of those things will normalise? What are your thoughts?
Look, I think what we're seeing is that that's beginning to normalise now. We predicted that it would get back to sort of reasonably normal levels by mid-23, and I think we're on track for that as far as I can see. I'm still involved in supply chain. I was in Istanbul a couple of weeks ago. I mean, interesting, there's more pressure on Near East than Far East now, because I think a lot of people have been heavily reliant on China. And obviously with all the problems that we've had in China with containers in the wrong places, shipping costs, COVID restrictions, travel restrictions, buyers haven't been able to travel as easily and freely as they've been used to, which has been good for the CFOs because their travel budgets has dropped significantly. But I think from a supply chain perspective, it's definitely looking more positive now. And there's a lot more capacity coming through. 6 months ago, I was struggling to get capacity in factories because the US buyers had gone into places like Bangladesh and mopped it all up. They'd been buying heavily out of China. Whereas now, I think with the global problems and the fact that everybody's overstocked, suddenly lots of factories have got capacity. So I'm hopeful that by mid-23, we're going to see us back to sort of normal levels, I hope.
Thanks, Damian. And Sophie, and Damian's point on nearshoring and bringing back to the UK, what are we seeing across our clients on, are we seeing that move? Are we seeing the positivity of perhaps having things closer to home?
We are seeing some of that move, but that does take time. And I think the challenge that retailers have got at the moment is that they need to take some immediate actions. I think just going back to the supply chain, I agree that there has been an easing of it. I think inevitably, you know, there have been so many factors that have impacted the supply chain. It actually takes time to reverse the impacts of all of those, whether it's been staff shortages, the product themselves, or the freight costs. And we've certainly seen the freight costs come down. I would actually turn it a little bit and say that the real challenge now is for retailers to buy smartly. I mean, we could even find that, you know, the replacement cost of the inventory that they bought in the past 12 months is actually higher now because of the very high freight costs that they paid in order to get this stock in. So the key focus now is to buy relevant inventory that will sell through, and really understanding the customer to buy smartly.
And picking up that point, we've talked both in our retail trading update that a lot of retailers have a very high level of stock. It's been a common theme throughout the whole of this year. As we look into 2023 and we pick up some of the points that Sophie raised on volumes being lower, general demand, what should people think about when they're purchasing stock? Is 2023 a year to have a fairly benign year and play the safe game versus being overtly ambitious? Tom, your thoughts on that point?
Yeah, it's really interesting. It's difficult, I think, for a lot of retailers to actually forecast a significant volume decline and therefore buy appropriately for that. Most businesses, you know, think they have a good understanding of their trade and they look to previous years to get comfort in knowing what volumes could be. I think the last 2 years volumes have been completely distorted, and I think you've now got people not understanding what true demand looks like going into a period where demand will be less anyway. So I think a lot of people will trade heavily, will see continued discounts so that they can get cash in, and we'll have to see what detriment that might have on some brands that maybe can't afford for their brand to be as seen visibly to be discounting, but they can't afford not to from a cash perspective, so it will be challenging.
And Damian, any thoughts on that challenge of discounting versus holding that price point from your experience in the market?
Yeah, look, I think Tom summed it up pretty well, actually. I mean, for the retailers I'm speaking to, you know, there's a lot of inventory in the market at the moment, and they've got to clear that stock. They've got to turn it into cash. And we all know traditionally that businesses from the retail sector massively struggle when it comes to January. You know, I've been a supplier to many, and sadly it's always in January when the bad news comes that those businesses might not survive. So I think we're going to see a lot of discounting in the sector, unfortunately, because there is excess stock. Black Friday didn't deliver what it was supposed to have delivered. We've had unseasonably warm weather right through to mid-November. So, you know, the coats and scarves and all that stuff, and now we've had the cold snap. So sadly, I think we're going to see plenty of discounting, unfortunately.
And Sophie, you know, you talked about adaptability and change being the key to success as we go through into 2023. That should people be as nervous as we have been about holding their price point? Is 2023 just a year where we have to trade through, we have to get through, you know, really focus on getting into what hopefully, and fingers crossed, there is going to be one of our updates in January where I get to say this is going to be our year of stability. You know, getting to that point, you know, picking up James's point, it's not going to be easy. So your thoughts?
It's not going to be easy, and I think the key priority for the consumer is going to be value. A larger proportion of their purse, as we know, is going to go on essential spend. So it will be more difficult to entice them to part with their cash for that discretionary spend item. And therefore, the more that it's value driven, the more that it's relevant is going to be key. The problem is you can't stand still, because at the same time, it's not just about demand, it's also the cost that retailers are seeing increasing in their own businesses, and they're going to have to choose what they stop doing and look at the areas that they do need to invest in order to make their own businesses more cost efficient as well. So yes, it's a period of let's get through 2023, but they do need to continue to invest where they can smartly and make sure that they really do understand their customer and drive and deliver a relevant product.
And I would love to spend a longer time this morning chatting with all of you guys, but we always try to wrap these things up on time. So with that, I'm going to thank each and every one of you for joining us this morning. I'm going to thank the panelists for what I think has been incredibly insightful. Damian is more than happy for people to reach out to him for any further information around some of the topics that he's discussed this morning. Damian, your email is there, and I'm sure you'd be happy if people either contacted us at BDO and we can connect you, or contacted you direct.
Absolutely. Thank you, Laura, for inviting me along. And I think, as you summed up at the very beginning, the only thing that's certain in this market is uncertainty. So thanks for having me along.
No, absolutely. It's been a real pleasure, and I've already had a couple of comments come through to us as to how it's been great to hear some of your thoughts. So we wish everybody on the call well for the remaining couple of weeks of trading. We look forward to seeing hopefully all of you in our January trading update, where we'll be going through our trading forecast in full. If you do have any thoughts, please do share them with us ahead of that, and we'd love to incorporate them. And we look forward to seeing you all over those dates. So have a very good Christmas to the audience, and we'll see you in 2023 and all that brings. Thank you, everybody.
Thank you.